the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Coming up in today's show, the Fed holds rates steady and says forget about a cut in March, leading to the biggest sell-off in stocks this year, led down by tech stocks, an ominous warning signal, and how to invest in the uranium bull market. Hey, what's up guys? Welcome back to Click Capital Daily Market Show. I'm your host Jared, and I'm going to get you all up to speed with everything happening on Wall Street and across financial markets on this interesting Wednesday. And what a day it was. The biggest sell-off we've seen all year and for some time, led down by mega cap tech after we got earnings from Alphabet and Microsoft yesterday, along with AMD. Then we've still got some big ones coming tomorrow. Apple, Amazon, and Meta on deck. However, it was pretty weak across the board, not just in tech, but also in financials, consumer cyclicals, industrials, and energy, oil, and gas. We did see a little bit of a continued defensive rotation into healthcare stocks and a little bit in utilities. Let's look at the S&P 500, down 1.6% today, closing at 48.45. There's a composite chart of the Magnificent Six, having its biggest down day in months, finishing 2.7% lower collectively as a group. Nasdaq as well was down almost 2%. And small caps finishing quite lower as well on heavy volume. Also got a little bit of a spike in the VIX here today, but the standout was Alphabet. Google down a huge 7.5% for a $1.8 trillion company. That is a huge move. So only yesterday we're trading really technically overbought, and here we are already below its 50-day VWAP. Stick with me, I'm going to come back to all these tech stocks and we'll have a look at what some of the others are doing going into their earnings as well. First off, let's get into the biggest news today. That was the first Fed meeting for the year, in which J-Pow and his team kept rates on hold and kind of pushed back on the possibility that they're going to cut rates in March, like a lot of the market had been hoping and expecting, with him going on to say the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation has moved sustainably towards 2%. He did say it will likely be appropriate to begin dialing back policy restraint at some point this year, but the economy has surprised forecasters in many ways since the pandemic, and ongoing progress towards our 2% inflation objective is not assured. So basically they're kind of caught in the middle here between not wanting to leave rates too high and choke the economy and send unemployment blasting high before they can get out in front of it. Also, they don't want to pull back rates too early and lay the grounds for a resurgence in inflation. Then they'll really have egg on their face. And here's a look at their latest statement compared to their previous statement, with the text in blue and crossed out being in their last statement, and the text in blue and underlined being in this current statement. So basically said recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have moderated since early last year, but remain strong, and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. And interestingly, they removed this text from the previous statement in which they said the US banking system is sound and resilient. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. So we're seeing a bit of a pullback in yields over the last couple of months, which has actually helped to loosen financial conditions. They also added a new text this month saying the economic outlook is uncertain and the committee remains highly attentive to inflation risks. So by the sounds of it, Jay and his team are not fully convinced and ready to declare victory on inflation yet. Reading through the lines, they kind of think that inflation is done. It should be done. However, they're still not 100% on that. That's why they're not ready to signal when their first rate cut is going to come. And it just may be that Jay's had a bit of a heads up look on the jobs report we get out this Friday, like we do the first Friday of every month. May come in a little hotter than expected. We've also got another half dozen key economic data releases before they meet again on March 20, with the big one being January's CPI, due on Feb 13. Then we'll get the PPI Feb 16, PCE Feb 29. Then we'll get jobs CPI, PPI again in early March before they meet. So a lot can happen between now and then, especially if these prints come in hot. The market's going to keep pushing back and back when the Fed's going to cut rates, which it's already been doing for a few weeks now. Before, the market was almost convinced they were going to cut in March, around an 80% chance. Now that's only sitting at 35% chance. However, the market's still convinced the Fed's going to steadily cut rates at every meeting for the rest of the year. And that's why we didn't get a bump up in Treasury yields today, actually finishing the day lower. Still thinking Jay is trying to talk tough, however still heavily betting on the fact that rates should consistently fall this year. You can see that in the price action of the 2-year yield today. Falling a healthy 12 basis points, down to 421, and we had some falls right across the curve. 10-year falling almost 12 basis points and losing 4% again. We'll be watching this recent low to see whether it can find support there or not, because if the 10-year lost that support zone and went below 370. That could be a sign that the economy is weakening, as it's already kind of lost that trend line it's been in since the COVID lows when rates bottomed out at historical levels. And just going back to tech stocks, after we had Microsoft's blowout quarter yesterday, really delivering some great numbers for the biggest company in the world, still growing their Azure and cloud business at 30% is very impressive. That's why we've got Wedbush's Dan Ives saying it was a masterpiece quarter. Microsoft earnings show it's on the cusp of a years-long $1 trillion AI opportunity. And on the back of that, he raised his price target for Microsoft to $475 a share from the current $397 we're at today. So they came in with a really good earnings beat, really good numbers, but the market sold them off pretty good here. It's a very bearish candle we got here today from these technically overbought levels, finishing on the lows on heavy volume. Not to mention Alphabet's huge dive as well. We did see a little bit of a buy the dip in AMD. Still finished the day 2.5% lower. However, after hours yesterday, we were down more than 5%, so it kind of held on a little bit there. And some people are saying Alphabet stock is a bargain in the Magnificent Seven now. And that's Citi analyst Ronald Josie increasing his price target on the stock to $168 from $153, maintaining his buy rating, given improving trends across Google Cloud, YouTube, and subscriptions as the broader advertising environment continues to strengthen. And I agree, out of all mega cap tech stocks, according to my indicators as well, stock fair value, it is the cheapest out of the Magnificent Seven, with it having fair value at $119 a share. And a lot of people forget, Alphabet still has the monopoly on the search engine market, absolute cash cow of a business. Not to mention a monopoly on video as well with YouTube, which is the #1 platform online and around the world for content consumption. So got these large moat businesses, and with a trailing 12-month price to earnings of 26, it's around a 4% earnings yield. It's actually quite reasonable, given how strong their businesses are. They've also got cloud and pushing into AI as well. On the other hand, Apple could be potentially overvalued here. My stock fair value's got it at 112. It's got a trailing 12-month price to earnings of 30, about a 3% earnings yield. I remember their revenue's been decreasing over the last year, and we're going to hear from them tomorrow after close on their earnings. And this will be an interesting one, as there's been some signs out there of them decreasing their orders of key chip components, and a sign that their iPhone sales may continue to dip, and coming out of China as well, an important market for them. The street's looking for revenue of $117 billion, earnings per share of $2.11 with gross margin at 45%. Goldman Sachs expects them to deliver results in line. We'll also be hearing from Amazon tomorrow night as well. And looking at Microsoft's results, they too should report good growth in their cloud unit, AWS. And since retail sales have been strong over the holiday period, they should come in line with expectations, if not beat them as well. The street's looking for a $1.03 in earnings per share. We'll also get to hear from Meta tomorrow night as well. They've been one of the best growing stocks of the Magnificent Seven. They laid off heaps of employees last year, got a lot more efficient, reduced their costs. We're still hitting records on daily active users and in their ad business. They're forecast to deliver $4.90 for the final quarter, with revenue expected to be up 21% from year over year. And there's a look at how Apple's trading there today going into earnings tomorrow. It's already been pulling back quite a bit with what's going on with the other ones. Amazon's holding on a bit better, still not really off its highs too much. Same deal with Meta, one of the best performers of the group, holding up there. Same with NVDA. However, we won't get earnings from them until the 21st of February. And there's a look at Tesla, which I'm no longer including in the group because it's the only one that doesn't have a $1 trillion market cap anymore, now just under $600 billion, and has definitely diverged from the rest of the group here. And so the stock market's been on a good rally for a couple of months now. Sentiment indicators have been pretty high, big bullish consensus, but now we've had a bit of a sell-off led by mega cap tech. That could be good reason for the market to go into a bit of a bigger correction, especially coming into some weak seasonality. As the stock market often pulls back in February during the presidential election years, just like we can see in this seasonality chart of election years here. Typically rally up in January, which we've done, then come the first week of February, typically rolls over, and that weakness can persist until mid-March. And like I've been showing on the weekly chart of the S&P 500 lately, the last two rallies we got went up about 20% before they got exhausted and had some 50 and 60% pullbacks. And this current rally just got above 20% as well. So we were looking a little exhausted here, and then just how the markets reacted after these tech earnings, even though they've been good numbers, may just be the liquidity event for some big money to take profits and get out. However, I would expect it to find support around that 50-60% pullback zone, the Fibonacci golden pocket, and that's around 4,500 to 4,450. However, most investors are still convinced that inflation is definitely going to 2%, and up until today, they were also convinced that the Fed was going to start cutting rates in March. However, look out if we get some hot economic data prints with the jobs CPI, PPI, and PCE that's due out multiple times before the March meeting, because that would catch a lot of bulls by surprise, including FundStrat's Tom Lee, who's already considering raising his 2024 price target after a strong January. Late last year, he gave a end-of-year target for the S&P this year of 5,200. He said the positive January for the stock market bodes well for further gains throughout the rest of this year, looking at increasing his target to 5,500. With him saying the price action earlier on is confirming we're on track for double-digit gains in 2024. This is on the back of the Fed, which is expected to ease financial conditions. And things are so good, we're even getting a new ETF that allows investors to track the market's red-hot Magnificent Seven. And looking back in history, this is typically a contrarian signal. When you see a strong theme in the market and then these new products come to the market targeting that theme, just like the magazine headline cover indicator, this can also be an indicator that a certain theme in the market could be reaching a boiling point near a peak. Not only that, we've got an ominous warning signal and something I've been noting on the daily show for a while now, and that's corporate insiders who are buying less and selling more of their own company's shares. And this is some research coming out of Argus Research Group, who said, I've tracked insider activity on a daily basis for more than 2 decades, and I've rarely seen a dearth of actionable insider buying. With them going on to say the cautionary signals are off the charts. Insiders are on a buying strike. Insider selling has ramped up dramatically in tech. Insiders have cast some doubt on continued growth, and we can see that in the chart that I track here of corporate insiders in the blue line. Yesterday only registering 42 purchases, which is historically very low levels. In the last couple of months, as the market has rallied, they've done a lot of selling in that time as well. And typically looking back in history, they have a pretty good track record of knowing when to buy and sell as a group, not only just in their own individual stocks. We saw that in late 2021, just before the market peaked out, they were doing a lot of selling, and actually in the depths of the COVID lows, they were doing a lot of buying as a group as well. So they're typically contrarian in nature, buying the dip, sell the rip. And one thing's for sure, they haven't been buying this market of late. And just moving on to a bit of a special piece I want to do for you guys today on the show. Like I said last week, going to do a bit of a dive into clean energy and the industries related to clean energy this week. And so today I thought I'd cover uranium, which is my favorite sector when it comes to things related to clean energy. Those of you who watch the channel, you know I've been a uranium bull for a long time. Personally been invested in it for several years. And uranium was one of the top performing commodities last year and is again already this year to date as well. So I just wanted to give a bit of a background overview of everything and some of the best ways one could invest in the uranium bull market, which I believe is still very early in its stage and could have many, many more years to go. And so first off, let's look at why uranium is the ultimate clean energy source, the most efficient source of energy, and why the world needs it and is moving more and more towards it. Well, to start off, just a 1-inch tall uranium pellet has the equivalent energy output as 120 gallons of oil, 17,000 square feet of natural gas, and 1 ton of coal. And just looking at the safety of nuclear energy, it is only second to solar in the world for being the safest form of energy. And in terms of greenhouse gas emissions, the amount of emissions per gigawatt hour of electricity, nuclear energy is number 1 at 3 tons, versus coal, where the world gets currently about 36% of its global electricity, a huge 820 tons. That's 273 times higher than nuclear energy. Oil, not too much better either. And so there's a look at the long-term chart of the price of uranium in pounds. Uranium doesn't actually trade on an open market like most commodities. Privately negotiated in contracts between the uranium producers, which dig the raw stuff out of the ground, also known as yellow cake, before it goes through an extensive processing and refining to turn into uranium fuel, given to nuclear reactors and utility companies to burn. So there was a huge run-up into 2007. Then we got the symmetrical crash. It had a little bump up in 2010. Then we had the Fukushima accident in Japan, and the world kind of turned its back on nuclear energy, and along with that, investment in new uranium mines. And then it kind of bottomed out. Then the market got wind of Russia's invasion in Ukraine, and Russia, who had been and still are an important part of the uranium nuclear supply chain, kind of woke the world up and has turned a lot of countries back to nuclear and wanting to de-risk from Russia's energy overall. And a lot of countries want to incorporate nuclear more and more as part of their goals to reduce emissions and create a more clean energy future. And so we've seen it rip up now, back above $100 a pound. Still a bit off those highs from $140. However, you've got to remember, that was 16 years ago. Inflation adjusted to make new highs, we're probably looking above $200 a pound. And just to give you a bit of an overview of the global uranium market, there's currently 436 nuclear reactors operating, with 173 more planned. And it's mostly the West that use uranium. But part of the big bull thesis for uranium is that there's a huge supply and demand gap forecast over the coming decades. We can see that here in the green with the forecasted of demand in metric tons per year and the current projections of production, because There's just been a huge amount of underinvestment over the last decade or so. And these mines and contracts and things take years and years to come on board and plan out. Not to mention geopolitical tensions in some key parts of the supply chain, with Kazakhstan being the biggest producer of uranium. However, important for the West going forward is going to be the production coming out of Canada and Australia, which actually holds the world's largest uranium deposits, because we've seen a bifurcation in global powers between the Western Alliance, G7, and the BRICS. So like I've been saying for a while now, I think that's uranium's moment. And we've just got a lot of factors lining up for why it should be a strong tailwind for many years. Huge supply deficits. Some forecasts showing supply will need to triple by 2050 to meet growing demand. Not to mention its end use of electricity is the fastest growing form of energy in the world. Energy sector is responsible for 75% of global emissions. 60% of US electricity, 80% globally, was generated last year by burning coal, natural gas, and petroleum. So the world's in a long-term secular trend of deleveraging from coal, and nuclear is going to be one of the big replacements of that dirty form of energy. And there's just a huge gap between supply and demand of it. And world leaders are finally coming to that realization, not just in the West, but in China as well, especially in the Eurozone. They really want to get off Russian energy. And unlike solar and wind, which the energy kind of comes and goes, is hard to store, it's a bit volatile, nuclear is a 24/7 clean energy with the lowest carbon footprint, lowest material requirement, lowest land usage, lowest cost per unit, best safety record, and aligns with the ESG demands that countries are setting themselves now. And there's a look at the process of uraniums dug out of the ground in raw yellow cake, then goes to conversion, enrichment, fabrication, then delivered to the reactors. Okay, so we understand the bull thesis for uranium nuclear energy. We understand why we want to invest in it. What are some of the investment options out there? Well, I've compiled a list of what I think are the 5 best stocks and 5 best ETFs. And let me just start off by saying this is not financial advice. Please do your own research. I'm just sharing my research with you guys here today. And the first one is Cameco, the largest uranium stock in the world, coming in at a market cap of 20 billion. They're quite a diversified company operating in the exploration and mining, milling, purchase and sale of uranium, fuel services, kind of the whole supply chain. They've been around since the late 80s, headquartered out of Canada. Also coming out of Canada and a lot smaller is Denison Mines at 1.78 billion. Both these stocks are listed in New York, and they're more involved in the exploration, mining, and development of uranium. Third one, also trading in New York, but headquartered out of Canada, is Uranium Energy Corp, coming in with a market cap of 3 billion, and they too are focused on the mining of uranium, with mines in the States, Canada, and Paraguay. The last one out of Canada is Uranium Royalty Corp. They're a bit smaller at 381 million market cap. They have been on a good rip lately, and they're a bit different. They acquire and assemble a portfolio of royalties, physical uranium holdings, and investing in companies with direct exposure to uranium. I think Australia is going to play a very important role in the future of uranium, if not the most important, since they have the world's largest deposits of the yellow stuff, with the leader being Paladin Energy, 3.7 billion market cap. This trades on Australia's ASX exchange. They got projects Australia, Canada, and Namibia involved in the production and sale of uranium. Another Aussie company with big potential is Deep Yellow, trading on the ASX with a market cap just over 1 billion, and they're a bit more early stage in their life cycle, still exploring and developing uranium properties. I think all these companies got big tailwinds behind them and should see some government support as well to get it done. Less risky options than single companies to get exposure to uranium are some ETFs like the Sprott Physical Uranium Trust, trading on Canada's TSX. And this is basically the only fund in the world that can kind of give you direct exposure to uranium, as they actually hold physical uranium in the form of uranium oxide and concentrates to kind of give you exposure to the actual price of uranium. Same fund manager actually has a uranium miners ETF listed in New York. That's pretty healthy in size, 1.86 billion in assets under management, has exposure to 39 different uranium related companies with dividend yield of 3.2%. with expense ratio a reasonable 0.83%, and that's a basket of companies with the criteria of them devoting 50% of their assets to business operations related to uranium. If you want a bit more beta exposure to the sector, same fund manager offers a junior uranium miners ETF, a bit smaller with exposure to 34 related companies. Probably the most popular one people know of when it comes to uranium is the ETF URA. That's from the fund manager Global X. Exposure to 48 companies, dividend yield of 5.51%. Seen some strong volumes coming there of late. And then my preferred pick, which is part of my top 10 ETF picks for the Click Capital channel this year, is the smaller Uranium Nuclear Energy ETF NLR. It's only 146 million assets under management, 4.28% dividend yield, Total holdings 26 companies, and is a bit more diversified with its exposure. 55% is in North America, 23% in Europe, 13% in Oceania, 8% in Asia. Decent expense ratio, 0.61%. And unlike URA, with pretty much half the fund, and Cameco and the Sprott Uranium Trust, this one's more diversified. They have a max individual weighting at 8%, and it gives exposure to not just uranium, but also nuclear energy companies as well. So a bit more of a broad exposure. And there's a look at some of its top holdings, some of the companies we've just covered, and a bunch of others as well. So this one is what I'd say is probably one of the safest ways to play this theme. And there's a look at its long-term monthly chart. As you can see, still well off those highs from 2007. Stocks have actually lagged the price of uranium itself. And you can see that when I overlay this chart with the Uranium Sprott Trust over on the TSX, well ahead of the stocks. So don't get me wrong, this sector is volatile, likely to remain volatile for many years. And just because it's in a bull market doesn't mean we can't have a 20, 30, or even 50% drawdown at some point over the next couple of years. This is really a theme to play for kind of like the next decade. This is a real long-term kind of secular bull market, in my opinion. And so if you haven't already, hit that subscribe button to this channel on YouTube, and I'll keep you updated on this trade industry and the best funds and stocks to gain exposure to it. And just moving on with the rest of the daily show, looking at market breadth today. Even though we sold off pretty good, still had 373 stocks and ETFs breaking out to 52-week highs. Still not many breaking down to 52-week lows, only 82 today. Got the dollar index still tracking sideways, just above 103. Same with Bitcoin, not too much happening there. Still got a pretty strong bid and shipping rates, and gold just holding ground above its 50-day VWAP. Bit of a pullback in crude today, still above $75 a barrel. We're looking for it to hold its 50-day VWAP to confirm to us it's still on an uptrend. Bit of a continued pullback in China securities today. Looking at my clean energy list, still pulling back, bit of softness here, with a standout being hydrogen, actually up 2.9% today. And come back to the show tomorrow, because that's the next sector of the clean energy sector I want to cover for you guys, and something I find interesting as well. I'm going to give you a bit of an overview of what's going on in the hydrogen market and some of my best picks in there as well. International stock markets closed a bit earlier than America, but they still had a bit of a weak session. A little bit of a pullback in growth versus defensive names. And we're seeing that with a bit of a pop-up in consumer staples versus the S&P 500, and continued moves down in discretionary versus staples. A bit of a defensive rotation going on in the market here, which is normal to see in a correction, or a small pullback, which is definitely happening now. We've had a bit more of a correction going on underneath the surface in breadth. It's just whether that short-term pullback turns into a medium-term correction, which we'll be keeping an eye on. We can see this in the spread, high-yield bonds versus treasuries, having a bit of a sharp turn down today. But inflation expectations falling back down here, and the weakest sector today by far, big dive in regional banks. After one of its biggest components, New York Community Bancorp, reported earnings today, got absolutely bushwhacked, down almost 40%, absolutely missing completely on earnings, reporting a huge loss versus an estimate of a profit. And that's not good news just after we got the release that the Fed's shutting down their $161 billion facility that banks had been using since the regional banking crisis in March last year. It's not going to look good if they have to open that back up again. And in a sea of red, the only sector that rose today, aerospace and defense. With geopolitical tensions, these stocks are holding up there. The other top performing sectors, but still finishing a touch lower, was healthcare and utility. My picks this year were down overall for the day. Cannabis still holding up there really good. My number one pick for the year, now up over 35% year to date. Had Intel continue to tick lower after its earnings, but we're looking for it to hold this $40 price level, and GM continuing to hold ground after its earnings, actually almost getting up to $40 a share today, and the telecoms still holding up there pretty good as well. But these regional banks got sold off hard today. Even the big guys had a little bit of a pullback along with most of the market. All right, guys, there we are in the S&P 500. The biggest bearish breadth day we've had in quite a while, even though we've got some good earnings numbers from the big guys. I think it's just a good reason for the market to kind of take a bit of a breather here. Some profit taking. There's already been a bit of a correction going on underneath the surface of the market for a few weeks now, which we can see the amount of stocks above the 20-day average. It's kind of been turning down for a while here. Did get a pop up in VIX today, but overall it's pretty chill. Yields are back down to their lows. Crude's kind of consolidating a little bit, and it's a bit of a sharp fall in the Magnificent Six. So there's a bit of defensive rotation. Just a normal pullback in the market. We'll just be looking for continued signs that could turn into something else. Maybe a medium-term correction, which if we keep seeing breadth going down, and a lot of these moves into the defensive groups, that could continue confirming that. Other than that, tomorrow's going to be a big one. Apple, Amazon, and Meta. So make sure you come back for that, along with my deep dive into hydrogen, something not many people are talking about at all. Thanks very much for tuning in today and hitting that like button. Look forward to reading your comments, and I'll see you all again tomorrow night. Cheers.